So we have new updates coming out of Washington, D.C. on the Silicon Valley Bank collapse. They announced they're going to be bailing out all the customers that were going to potentially lose money. So it was already noted that the FDIC were going to cover all the insured deposits up to $250,000. The problem was that the bank had over $209 billion in assets, and of that, 90% was classified as insured. That means depositors were going to lose $188 billion. So I'm sure the government had these two things in mind when they were deciding that they need to bail out these customers. One is that a loss of $108 billion is enough to wipe out several businesses, because there's already been several people that took to Twitter sharing their story about their business and how they use that bank and how it's going to completely wipe them out. And of course, when businesses fail, it puts numerous amounts of people out of work. So not just the owner of the business, but also the employees as well. An increase in the employment rate would just further hurt our already struggling economy. So I'm quite sure that's something they wanted to avoid at all costs. The second factor I'm sure they considered is even bigger than the first one, and that's the fear of a nationwide bank run. Because they know if the American people sit back and watch the 16th largest bank just fail in front of their eyes, but not just fail, but at the same time watch customers lose $188 billion, I'm sure the level of fear that would create would be immeasurable. But not just fear alone, but think about the trust they would lose in our banking system. Banks, which is considered one of the safest places to store your money, would no longer be looked at as safe. And of course, no one would want to be a part of a broken system like that. So the result could very well be a nationwide bank run. We're talking billions of dollars of withdrawals across the nation, and that's across several banking institutions. And there's no way any bank can handle that type of run, because banks operate off of a fractional reserve system, meaning they only keep a small amount of your actual deposit as a reserve, usually around 10%. That means the other 90% they either invest or loan out to someone else. So I'm quite sure taking measures to prevent that from happening was definitely priority on their list. Now, one thing to be said about this bailout that's different from the rest is that they're not bailing out the bank itself, they're only bailing out the customers. So all the money that's not covered by the FDIC would be made whole. So the Treasury, the Federal Reserve, and FDIC put out a joint statement saying what their plans would be. In their release, they were quoted saying, "Today we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. This step will ensure that the U.S. banking system continues to perform its vital role of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth." They then went on to say that depositors would have access to all their money Monday, March 13th. Now, as far as where the money is actually coming from, that part's still a little unclear. However, they did go on to say shareholders and certain unsecured debt holders will not be protected. Senior management has also been removed. Any losses to the deposit insurance fund to support uninsured depositors will be recovered by a special assessment on banks, as required by law. So as far as what a special assessment on bank actually means, that's something we just have to wait and see. However, in the letter, they were very clear about stating that the money would not be coming from taxpayers. Again, whether that's true or not, only time will tell. So I'll definitely keep you guys posted as new updates are released. So don't forget to hit the like button, subscribe to the channel, and I will see you in the next video.